The really interesting thing that came out of the budget, two parts. One is that the budget isn't law yet. Even more importantly is that there's an election coming, well before any of this is going to become law. But something even more important, well before any of that, is 30 June. It's the date in the calendar that accountants get very excited about. The use of the 30 June date is to get planning sorted. Action required. Tax minimisation. It's a must. If you let that day go past and you haven't attended to what you need to attend to, you can't call it back again. The basic tried and true principles of tax planning still remain the same. So you've got delaying receiving assessable income. Don't collect it now if you don't need it. Obviously that has a cash flow impact. But if there's something that you can put off till tomorrow regarding assessable income, put it off till tomorrow. Vice versa, bring forward deduction. It could be something, $20,000 capital expenditure that we have to be able to claim that 100%. You might be thinking that there's a capital item to purchase somewhere soon. If the cash flow allows, then 30 June is looming, do it now, get the deduction now. That also includes prepayments. Now, for some people, there'll be an ability to prepay up to 13 months worth of expenses. Anything from leases to rents to maybe some insurances. So that's another one, cash flow impact, but very important. Negative gearing is a little bit more difficult these days with the low interest rates. Good rental returns. You can negatively gear in property, shares, other investments. Property is the one that usually catches people's imagination. If that's something that you do the numbers, always do the numbers, relate it to your own circumstances, and if that's something that's happening and can relate to a good investment and tax planning advantage, then get stuck in. Super. Now that's super, that's anything from employees super, the normal SGC that you would pay by the 28th of each quarter, possibly each month. You will get a tax deduction this 30 June, every 30 June, if you have it paid by the 30 June, actually in the employees' accounts, done and dusted. So yes, it might be something that every 28 days you're making that superannuation payment, but bring it forward. Your own super. Now that means possibly your own self-managed super fund. The same situation exists. If you want a deduction this 30 June, it has to be paid into the super fund, resting in the fund, starting to earn an income, most hopefully, and you'll get the deduction. Discussions about how much you can pay, what limits there are, all sorts of don't put in too much, etc. Talk to your financial advisor, Michelle. But it's a mere fact of getting the tax deduction that you're looking for. So again, pay really good attention to that. The comment is very much, move the money to where you can pay the least amount of tax, and that is in a trust, using family members on perhaps a lower tax bracket to distribute income to. It also includes looking at what they commonly refer to as bucket companies. Now, a bucket company is pretty much a company set up simply to take a distribution from a trust. There's been plenty of bucket companies known to be set up in the dying days of June each year. Takes a distribution, pays its 30% tax, and depending on who gets in, back to the election, that might become 25% somewhere down the track. You've paid tax at a 30-cent rate as opposed to a rate that could possibly be higher in your own name. But again, the very important thing is for all of these strategies to be worked out on your own circumstances. One size does not fit all. There are issues relating to probably all of those strategies and plenty of others. So you need to do the numbers. I come back to the first comment about planning. So it's really getting together all the information, talking to your trusted tax advisor, and getting what you can done before the 30 June. There will be another 30 June, but that's for next year.